Okay, welcome everyone.
那个要钱的。Okay, it's being recorded.
你现在听不见谈话吗？你得把那玩意儿打开吧。
Welcome everybody. I'm hailing over from Wisconsin, Elkhorn, Wisconsin, and we're just here on vacation. We're having a great time. I hope you guys had an amazing service, an amazing week, and that God is treating you, as good as He always does. So we just have to be grateful for the opportunities. But I should be able to join you live next Sunday unless something changes. Check your waiting room. Okay, hold up. Okay, Stephen is telling me that I need to check my waiting room. So let's see how we do that. It should have popped up, but it didn't. So trying to see. Steven is saying that. Oh, there he is. Steven is joining us.
2个 host 的都来了，2个老师。
Okay, so.
Yeah.
All right.
Sorry, Guillermo was having some issues.
Yeah.
I know you want to drive back. Yeah, let's get you. Thank you so much. It was great today. Very excited. Praying for you guys.
Okay, so here we go. So the idea today is to cover the 4 main strategies to invest. There's actually only 4. The rest of them are just offshoots of the 4 main strategies, and a lot of people get confused with what that means. But basically, is we're going to go through the 4 main strategies, and I'm going to describe them, and then please ask questions about each individual one, and then we can go from there. So I always like to emphasize the difference between trading versus investing. Today we're going to talk about more investing, and those are the 4 main strategies. Trading uses some of those components as for from investing, but obviously it's on steroids. So you invest faster, you invest a lot more money, but with a shorter amount of time. So what is it? Well, trading just involves higher risk, which means it could translate to higher profits. You could lose all your money and you can make a ton of money very quickly. It's not for everybody. Whereas investing, it's more of a traditional, what you're used to. Let's try to get 8 to 10% per year. This year has been really, really difficult, obviously, for everyone. We have seen a bear market. We're a little bit above that on the S&P 500, and then the NASDAQ, we're still seeing some of that. In trading, everything is just faster. So the holding period could be from a few minutes to a few hours, few days, sometimes every now and then a couple weeks here and there. And whereas investing, you tend to hold something for months or years at a time. And so obviously there's different things that happen with taxation when you hold longer versus when you hold shorter. And the taxation when you hold longer is you just get a lower tax rate versus trading quickly, you get a higher tax rate. And so you have to offset the higher tax rate with higher return, which is why it's higher risk. And then lastly, trading involves in and out. And so there's going to be a lot higher costs when you're doing that. And the reason is because there's transaction costs. Usually when you're trading, for example, options or futures, but stocks, there isn't much of a charge on that, or ETFs. And so that would be okay. But the reason why a lot of people trade is because they want to maximize profit. So they will do the things that do cost money for the most part. So I hope that clears that up. And let's talk about the 30,000 foot view of the 4 strategies. So at the beginning, And when I say at the beginning, before 1950s, it used to be that people would buy a stock and just hold it forever. And for example, I've had clients that still have AT&T stock that used to be Southern Bell. And they've changed and they've held that, and they continue to hold that actually. Other people would buy whatever bond that was at that point, and they would buy the longest one and hold it as long as possible. So that buy and hold idea it feels good, right? Because you don't have to make another decision. All you have to do is just purchase what you think is a good company, a good stock, and then don't ever worry about it. It'll go up and down, and ideally you can continue to buy as time goes on. So this strategy, if you wanted to use it now, you just buy the S&P 500, and you see me, I wrote down there SPY. So the SPY is the components are the top 500 companies. And so that gives you some diversification, but it also allows you to participate on the upside. It tends to be better than just holding one stock, but you won't make as much money. For example, if you would have bought Apple early on, and today you know the price of Apple, but then you wouldn't have bought XYZ company that nobody knows the name of because it went bankrupt, so you wouldn't have lost your money. So it's a give and take on that. Generally, the buy and hold strategy has higher upside, but it has a huge downside, which means, like, for example, in the bear market of 2008, you saw 50% of your money evaporate. Now, since you're holding and you don't intend to sell ever, then you would have recovered. So that would have worked out very nicely. A little known fact was that from 2000 till 2010, if you would have invested your money in 2000, you really wouldn't have made any money. So you would have invested 100,000 in 2000. In 2010, you would have the same $100,000. So that's hurtful, right? Because you have life, you have plans, you have all these things that are occurring, but yet you're not seeing your assets go up in value. Obviously, inflation is a big deal, but even back then, inflation was kind of high. So it's one of those things you got to keep pace with. So the next one is a 60-40 strategy, and it's really, and I'm going to go more in depth in these, is you hold 60% equities, which means like the SPY, and then 40% bonds. And then the next one that appeared was multiple asset class. And there's different types of the multiple asset class, but the idea is that you don't just hold the two asset classes and the 60-40 portfolio. You hold more. As you can see, you have US equities, international equities, commodities, real estate, and bonds. So the last one is momentum. Momentum is sort of like an idea that goes with the multiple asset class allocation, but you end up just holding one or two instead of all five, and you just pick the one that's the strongest. Okay, let's go a little more in depth in the buy and hold. So the buy and hold, like I said earlier, tends to have most of the time higher upside, but it also has higher downside, which means that its risk adjusted return is not as favorable as the other strategies. So now, is it better than not investing? Absolutely. So if you never want to worry about something and you just want to go, all you got to do is invest in the SPY and then really buy as time goes, right? So you get your paycheck, you put in a certain percentage of dollars, and you just keep buying, and you never sell. So the issue that a lot of people have is that this strategy is very taxing on your mindset. And that's because when the down markets come, and they always come, is that your statements would be will hurt your feelings just because you see that number really come down. But if you continue with the discipline of just buying, this is called dollar cost averaging, then your assets will continue to grow over time. This is really good when you have a long time to invest. If you're younger, it's a good way to do it. One thing that I always like clarifying, and this is just, I'm going to use the numbers that the insurance companies use, is that if you're married and you're 65 and over, one of you is going to live to 91 or later. That's what the numbers say. There's a super high percentage that one of you will live to 91 or over, which means that you have like 25, 26 years to invest. And that's a long time, which means this still may be appropriate depending on your situation for you to invest that way. The difficulty lies in you creating income to live off of because you're not working anymore. So there's some offsets. So let's move on to the next one, the 60-40 strategy. So there's this guy, his name is Harry Markowitz. He decided that actually he researched that investing shouldn't just be buy and hold. And it used to be that if you bought stocks, you only bought stocks. And if you bought bonds, you only bought bonds. People didn't really mix those two. And what he came up with in 1952 is that why don't we buy 60% in equities and 40% in bonds? And so what ended up happening is that you had less downside and the higher expected return. That doesn't mean that it always happens, right? But it tends to be that the expected value. So if you took, taking the idea of basketball, if you took 100 shots, you're more likely over time, if you took 100 shots a day, that you were going to do slightly better than somebody just taking one shot and making it. That one shot being the buy and hold strategy, the 100 shots being that, hey, I'm going to average 70% of my shots. So that's kind of the idea behind the 60-40 is that our average, the expected value is going to be higher and a better risk adjusted than the buy and hold strategy. And by the way, this is still prevalent. You'll run into this pretty much any 401k company that any company that offers a 401k company has this available for you. It's a very easy strategy to implement because all you got to do is imagine your $100,000 portfolio. You're going to put 60,000, for example, on the SPY, like we talked about earlier, which is the top 500 companies. And then the other 40%, you can either do a mixed bag of whatever bonds they offer, or just pick the general bond fund, which is AGG. That's an ETF. ABNX, I think, is the ticker for a mutual fund. And so basically, you're just looking at the bond fund that will invest in different types of bonds. And then every 6 months, if let's say equities grew to now that you have a 65% portfolio versus 35% bonds, then you make it where you rebalance it. So it's now 60-40. So that one takes a little more activity than the buy and hold, but it's worth the activity just because you're able to capture a higher expected value. So that's always good news, that we're always looking for a higher expected value. We always want to be able to find returns with less downside. So in technical terms, if you're interested in this is called the Sharpe ratio. And the Sharpe ratio is something you can find in different, if you buy a mutual fund that does this, they'll post the Sharpe ratio, that number, the higher, the better. And just for reference point, the SPY, which is like the buy and hold strategy, carries at about 0.68 to 0.7 Sharpe ratio. So anything above that is a big win. Let's move on to the next one. So multiple asset class. So multiple asset class is, again, a reiteration of that buy and hold where Harry Markowitz added bonds. But now David Swinson says, well, why don't we just stop at equities, US equities and bonds? Why don't we add more? And so this is a progression where the downside is actually lower and the returns, the expected value return, is higher. So we improved upon the first two strategies, and we got it to the point where we can feel really confident that we're going to reach our goals because the expected value goes up. And this is a little more complicated to execute just because there's more rebalancing that occurs. But given that most websites allow for automatic rebalancing, that may help you. And all you're going to do here is that we're going to pick, and it's depending how you do it, but the easiest way is you pick 5 asset classes, and those would be US equities, international equities, bonds, commodities. So like commodities would have done a really good job this year, not in the last month, but before the last month, your commodities portion of the portfolio would have really helped you to offset the losses in both bonds and equities. And I'm going to do a little review of what each strategy did so far this year, and then I'll give you my opinion for what it's worth in the coming future. And then the last one would be real estate. So real estate usually does really well with inflation up to a point, and then once the Fed, like what they're doing, and starts raising interest rates, then real estate starts to drop in value because not a lot of people can buy. So anyway, what you do is you put 20% of your money in each one of those asset classes, and you can just do it blind. A lot of people get a little more sophisticated, and there's many ways to execute this strategy, but a lot of people get sophisticated and say, hey, like the way the economy is going, it looks like equities would do better. So they might do 25% equities or 30% equities as opposed to 20% in each. But let's just keep it simple here. And so what you would do is that same $100,000, you'd put $20,000 each in US equities, international equities, bonds, commodities, and real estate. So if you did it that way and you just rebalance that every 6 months, so you just make sure that you stay at that 20% each, obviously what you end up doing is that the ones that have gone up, you take profit from there, and the ones that have gone down, you put it into the ones that have lost. For example, US equities, you would have taken money out of commodities and you would have put it in each the US equities, international equities, and bonds, and then that would have made you whole again to 20%. So going back, I just want to review a little bit of the downside. Let's do the momentum last, and we'll go back and do the downside. All right, so the 4.0 version of everything is the idea called momentum. So momentum is little research up until 1997, very little research strategy that wasn't being used a lot. And the reason is because Harry Markowitz came up with his modern portfolios theory, which really fits nicely in the context of educating in finance classes. So it's really nice to show all the numbers. They have momentum. There's a little bit less than that just because it simplifies the situation. What I mean by that? Well, all we're looking for is the area that is growing. And then when it's not growing, you move out of it and you jump into the other area that's growing. So a guy named Gary Antonacci wrote a book called Dual Momentum. And Dual Momentum does a really good job of jumping on board when things are going up and jumping off. And we call it risk on, risk off when things aren't doing well. So the idea is that when the stock market is going up and it's worth taking the risk, you're in the stock market. And then when it starts to decline, it forces you to go into safer assets. It's tended to be bonds until this year. This year has been an anomaly. In fact, an anomaly that has only happened 2 other times in the last 60 years. So it's been very interesting just because the way that things have worked out, that the momentum strategy, along with the other strategies, have had a difficult time performing this year. But looking at the long term, how does it perform relative to what other strategies are saying? And that just means there's lower downside again and higher expected return. So mathematically, the statistics show that this is the best strategy to implement nowadays. The difficulty lies in the execution. And the reason is because how do you know when to jump off something and jump onto the next? It could be like, for example, the last week, the US markets have done pretty well, especially the NASDAQ. And it's expected that we're going to reach a certain number where if it does go through this number, then we should see more upside. I anticipate that it's going to have difficulty and it's going to come back down, but obviously that's always an issue. So you can see, right, the difficulty. There's a lot of maybes. And so obviously there's protocols you can use. And the way that dual momentum actually works is that what you do is you look at the last year's performance. So for example, let's say we're going to invest tomorrow Monday, we're going to invest $100,000, and you say, hey, I want the growth strategy of the momentum strategy, right? So what you would do is take the 100,000, but you would look at how have the last 12 months done. You're going to measure US equities, international equities, along with emerging markets, and you're going to see which one of those did the best over the last 12 months. And so I don't know, I'd off the top of my head, but I think the SPY has done the best in those three. And so you would compare that with what the last 12 months of bonds have done. Now, you don't use the conglomerate bond AGG fund. You can put it in there, but typically what you do it is by looking at different time periods. And those time periods would be long-term, which that would be the US Treasuries, and that would be TLT. TLT is a 20-year bond, and it tends to move a lot. When people are seeking safety from the markets, what they do is they enter into TLT. And so that brings the prices up, which thereby makes it so that you're making money when the equities are coming down. And then the middle term, which is like 7 to 10 years, it's called IEF. And so IEF these are ETFs. There's an equivalent version of these ETFs within mutual funds. The reason I talk in terms of ETFs is they're just less expensive. So I don't see the need why you would pay more money to accomplish the same feat using mutual funds. So the ETF, the 7 to 10 years, what it does is that it doesn't quite have the upside as TLT, but it also doesn't have the downside that TLT does. So TLT, think of it as more equity related. And what I mean by that, it behaves a little more like equity, but it does so in a time, usually in a time when equities, US stock market and international stock market is not doing amazing. So it's a really nice complement. So for example, in the 2008, 2009 financial downturn, the TLT ended up doing like 24% return. So those that were able to get off on the downside of the US stock market, which ended up dropping almost 50%, you actually gain 24% return. And wow, I mean, that makes a big difference when you are trying to retire and you have goals in mind. And so it's really nice to get off the roller coaster of the stock market dropping. And so it does really well. But anytime before that, TLT does, if the market is going up, it actually doesn't do that well. So the nice complement of IEF is that you get the best of both worlds somewhat. And then the last one is that if you enter a very difficult period, then you would buy BIL. So BIL is just really short term, like 0 to 6 month bonds, and it's just there more like a money market account. Just you have the safety of this US Treasury bill. So obviously there's mixtures in the momentum. You can in the growth strategy, you just buy one of those. So you compare how the equities have done versus the bonds, and then you just jump into bonds when the equities are not doing well. And then when the equities start doing well, they surpass the performance of the bonds, then you jump into bonds. Now you can see the difficulty, right? There's a lot of moving parts. Usually you want somebody that has experience to work on that, but it ends up being a really, really nice return for you over the long term. Obviously, one thing that I do have to explain is that every single one of these strategies has their weaknesses. It also has their down periods. And it could be years that some of them just don't work, right? So like I mentioned on the SPY, the buy and hold strategy, is that there was like a 10-year period where you made no money. And that's really difficult. So, and obviously the downside to this one is you could lose a lot of money. And if you specifically when you need it is when you lose money. So you end up taking money out that has dropped, and now you make a temporary loss into a permanent loss. And then we have to talk about still the psychological aspects, which is probably the most important part of investing in trading is that your mindset, where is it? And Stephen talked about in a previous class about your personality, your investing and trading personality, and how important that plays into what kind of investor you are. And so you have to be aware of who you are, and you say, I'm a gambler. So I would probably if you're a gambler, you have to establish discipline. You got to create a plan. You got to have it written down. This is how I'm going to execute. If you're doing the buy and hold, you're not going to pull out when things come down, because this is where the most potential gains occur. And in fact, you should be buying, specifically if you're a buy and hold strategy investor, that's when you should be buying. So that's the difficulty. The buy and hold represents the most difficult part of a strategy as far as an investor. So you have to think about that. So that's the weakness, I think, in the buy and hold. And obviously you don't want to see negative numbers. Then the 60-40 strategy is solid. You're going to do well in good times and bad times. Clearly this year, it has been one of the weaker strategies, just because you were anticipating having kind of like a support from the bond market to help you not lose money, and instead you're losing as much or more equities compared to equities. So it really failed this year to do what it has been doing, and so we're going to talk a little bit about why that's happening in a second here. And then multiple asset class between the three, just because they had commodities, in real estate, it didn't do quite as badly, but as you can see, I don't know if you know, but commodities up until the last year or so, for like the previous 10 or 15 years have been terrible. So you were carrying a dead weight for all that time if you were investing multiple asset class. And I know, because my firm used to use multiple asset class strategy for a long time, and it's a wonderful strategy, but it's sometimes you're like, you shouldn't be holding something, and yet you hold it for years and years and years on end. And oil, for example, right after 2009, which it reached like $150 a barrel, dropped during COVID, it dropped to negative numbers. They're actually paying you to buy, which is crazy. Instead of you paying, they were paying you to buy the oil for a time there. So you can see that commodities is just a tough space, very tough space. It moves real fast up, and then it just the next day it's down 10%. And so it's really hard to invest. It's barely qualifies as far as like an investment vehicle, just because of how much volatility introduces. But this year, it has been amazing. So if you would have, for example, bought energy or oil at the beginning of the year, and not this month, but through last month, you would have done something like 40% return. And obviously, in using multiple asset class, you would have been exposed to that upside, which means it would offset some of the losses that you would have had in both equities and bonds. Okay. The momentum, the weakness is when the risk on risk off measures of performance just don't work. So the main read on momentum is, how are bonds doing? And bonds are doing badly. So you stay in kind of like the buy and hold. Now, this is temporary because things should realign at some point. So it's still like your expectation of being able to take risk off the table is really handicapped when the risk off measure is not telling you to get off this risky investment. So you could develop, and what we've done is we develop alternate versions of the risk off, and it's basically, well, once the US markets reach this downside, we would anticipate more weakness, and hence let's get out of the markets and let's not experience some of that downside. So again, I don't know if you guys have questions. I'm kind of rambling. I don't see questions. So for those that are on the presentation, you stop me anytime to ask a question. Just let me know. Then I'll continue here. Okay, so Are we seeing a paradigm shift? This is the most difficult part. I think we're facing a really, I call it interesting, because whenever there's change, there's opportunity. And a lot of people have this fear. God tells us to not be afraid. And so we just act in faith, and we move forward. And God gave us brains in order to execute, our creative abilities to anticipate, to really work on things that are difficult for others. So that's one of the main reasons why I'm speaking here, is because I want to provide you the knowledge of that. Hey, there's always a way to deal with things. And so let me give you a really broad structure of what may be happening, the things that are different that really haven't happened before, at least not within my lifetime. And what is that? Well, like I mentioned, this anomaly where the bond markets are not performing how they're supposed to be performing, even within the time of the markets coming down. So there's usually a small lag time, which is the markets are coming down, then people jump into bonds, and then bond prices bond returns go way up. And what the Fed usually does when the markets go down is they drop interest rates. And so that further fuels the upside to bonds. So, but we've gotten to a point now where we're seeing inflation, and inflation is a big problem, because if you're sitting just in cash, it's eating at your ability to purchase things. So what the Fed has to do, because it's their mandate, is to control that inflation. And how do you do that? Well, inflation occurs for many reasons, but one of the main reasons is high energy prices, high food prices, and then labor markets just running hot, just because more and more people are working. And all that sounds great, but it's much like, I don't know, I'll give you the example. I love this example. So when I was in 6th grade, we had this experiment with a potato. And the idea was you plant a potato and you put it somewhere really dark, like under a sink where there's no sunlight. And so obviously my hypothesis was this potato plant is not going to grow, it's going to die. But what ended up actually happening, which I thought it was really interesting and eye-opening, was that the potato plant in fact grew like 10 times faster than the control, which was at the windowsill with the sun being watered nicely, everything. But what you noticed is that the potato plant stalk was yellowish and very skinny. And so all it was doing, it was expending all the energy of the potato to grow this stalk to find sunlight. So this is what is kind of happening or happened in the market during COVID. So COVID, we shut down the world. And in order to not have an implosion of the markets, the Fed had to release all this money into it. It's kind of like the potato plant looking for the sunlight. And so it's great because the market right after February 24th was like the first initial downside of the COVID market. And then April 6th was the first initial like upside. So if you would have gotten out not April 24th, February 24th, if you would have gone out of the markets February 24th and gone into the markets April 6th, from April 6th to the end of the year, you would have experienced some like 40% return. And so it's kind of like that. But what happened is that growth was not through a healthy growth. It was just money being fed by the markets. So what ends up happening is that now we're experiencing some of the issues of doing that type of, and look, it was a safety net. In the perspective of most people, that needed to be done. And so I generally don't agree with the idea. I think we went too far with it. If you were going to execute it, there's a little bit better execution. There's some traditional measures that you can use in order, even though it was not a traditional happenstance, but traditional measures as far as like monetary policy that were kind of offset. And so what ends up happening is that now you put in too much money into the markets, and the markets went up, and this is what we're seeing inflation. So the short of it is that we want to be able to make a change. We want to be able to make a change in how we look at investing versus the changing paradigm of the world. And that paradigm is that maybe using bonds as a safety net should be reevaluated. Maybe there's, and we'll talk about other untraditional asset classes that may help in the ability to, let's see. Yes, I newsletter. Oh, okay. I have a question here. I got a question here. Based on one newsletter, I'll read it. On inflation from Dom and Capital Research, they predict Treasury bond market to plunge more than 44%, somewhere between 50-70%. Could you please explain a little bit now? That could happen when I was looking at saving bonds such as IBO 9% interest rate. Yeah, okay, that's a good question. So the idea is that if can the Treasury bond market plunge even more? And potentially it could. I think we have a reactive government now that may not allow that. And let me paint the broad perspective. The world runs because of bonds. The United States runs because of Treasury bonds. And so it'll behoove us to allow this to happen. And so there's offsetting, Luis, offsetting competitions here, right? And one of those has to be with what's the right thing to do? The right thing to do is we have to get inflation under control.
I was gonna pick that up, but I thought I better just wait to see who it was.
You couldn't pick it up if you tried.
You saw?
Okay, I like that. So basically, it's one of those things that you have to offset inflation, but at what cost? Are we going to plunge our economy into a recession or even a depression? I don't think we're going to allow that to happen. I think, you know, inflation does come down when the economy starts to suffer, and we're seeing that, right? We've seen oil plunge like 10-15% here in the last month, and because we're anticipating a recession, which means that maybe the Fed doesn't have to increase inflation, the interest rates as much. And so it is one of those offsets that perhaps this is a temporary thing, and then we can stabilize interest rates for treasury bonds and treasury bills. And the whole world really likes buying treasury bonds and treasury bills because they trust us, right? I'm not saying we're like super trustworthy, but in relative terms to the world, in order to collect interest, we pay. And so, for example, if let's say the country of Zimbabwe issues bonds, do you think the world buys their bonds? No, because they don't know if they're ever going to get paid. And so they have to issue bonds that are paying 15-20% to entice people to buy their bonds. But the reason they're issuing such high interest payouts is because you don't know if you're going to get paid. So it's like a push-pull thing. And so what ends up happening is that I don't see how it could plunge. If it plunges that much, money is just not safe at that point. In investments, they'll all plunge. Everything will plunge. And so I don't believe in, I don't live in that world where everything's negative. You know, as far as I follow the Bible to a T. And so the end of days will come at some point. We don't know that day. We can't operate in fear. God tells us over and over again to not be afraid, right? So what we're going to do is we're going to act faithfully to bring more disciples, how we're asked to do in the Great Commission, and bring them to Jesus. And then as far as investing, just do the thing that is one of these four strategies will fit. It will do well for you. You can pick any one of them as how I describe them, and you will do better than just sitting not doing anything. A lot of people get paralyzed. I had one client. She was my client in 2005. 2008 came. At that point, we were only doing a little bit of the 60-40 portfolio. And so everything came down. The bond market did okay. She ended up pulling all the money out. She became again my client. So this was 2009. She became again my client in 2015. She had sat in cash for those 6 years. And those 6 years were actually really good at a really good investment period. If I understand you correctly. Go ahead, Luis. You want me to unmute you? you go, so you can ask your question.
So can you hear me?
Yeah, I can hear you.
Perfect. So if I understand you correctly, so you are telling me, basically you said the US Treasury bonds are pretty much tied to the government is running. So if you're talking about the risk, I'm thinking about if US government run into bankruptcy, then those things are gonna happen. But you are not that pessimistic to think that will happen in a very short term. So that's why we have to put the faith in investing in bonds in general, right? There are bonds are safer than the other are more riskier. So they are different category. But in general, you are saying that it probably will not be that bad. Even the inflation goes up to be higher later on than what we're seeing now, but it won't be that terrible.
Yeah, I don't think so. Obviously, it's like it depends which bond, right? Like if you're talking about the 20-year bonds, then we could see further downside, but it's already fallen quite a bit, especially the TLT. It's fallen quite a bit, and actually, if you see over the last 2 weeks, we've seen some nice recovery on those. So to answer your question directly, no, I don't anticipate the US. I think the US government would be the last one to fall. If you think about it in terms of where we stand, like for example, Japan is like in an atrocious situation with their money and their bonds. They're really, really in a difficult time, and they're expending trillions of dollars to support that. That I think that one is on the verge to collapse, way further ahead than the US. And obviously a domino effect could happen. And so this is always my point. We're not in a good situation in the United States, but we're in the best situation compared to the world.
That's
And
true. This is totally agree.
yeah.
Sure. Yeah.
So it's like, what is one to do if the US government collapses because the rest of the world has collapsed? And the last time we experienced something similar to that was World War II. And who benefited after that? The United States. So here's what I obviously take this with a grain of salt. This is just my experience and everything else that I've studied, but I could be just as wrong as anybody else. And what is that? Well, I think that as we see the domino effect happening, people will move their money into the United States, which will help the United States grow. I know. So I read a lot of Ray Dalio stuff. He's the Bridgewater. He runs a hedge fund, Bridgewater, and he writes a lot about the end of the US being like the power in the world. But I think he misses one point that's really interesting, right? And obviously this is my opinion, and that's that he misses the fact that the countries that have a partial faith-based acuity or like to God, right? Those are the ones that produce. If you look at historically, every country that aligns itself even partially to our God, our one true God, they actually tend to do well. Like Israel, every time they moved away from God, they fell, and every time they came back to God, they went up and they did well. And if you look, and why is that? Well, that's a whole other lecture that I go into, but basically is that you just allow kids to be creative, and creativity is the mother of inventions and technology is what moves countries forward in production and wealth. And so just from a practical point of view, as a country, you should become a God, Jesus believer, because your people will flourish. And so the thing with China, everybody's like, China's next, but nobody trusts China. They know like they do things in the dark, right? That people don't trust. So it's tough because while I agree with a lot what Ray Dalio is doing, I really do think that if we see this domino effect happening, all the money's coming to the US. So I at some point revelations come true, right? But not yet. And I'm we're asked to not live like that. We're asked to live to bless others, to love on people, to bring the word of God, and to continue living in that living it's one of those things that just allows us to really just allows us to have a good life really in the end. And you know, we're talking about treasury bonds, so like the smart investors always look at bonds. And so one of the things that I always do is I'm looking at the yield curve. What's the yield curve doing? We're all because it tells us, well, we do see a recession coming. We did have an inversion in the yield curve, so that usually means that in the next 6 to 9 months we have a recession when the initial yield curve inversion happens. And what is that? Just to explain to people that don't know what that is, that just means that the short-term rates, the ones in 1 year or less, are higher than the longer term rates. And so the reason that's a problem is because how banking works, how it's supposed to work, is that the short-term interest rates have to be lower than the longer term interest rates, because that's how banks make money. And banks are the drivers of the economy. And how do they do that? Well, they pay short-term interest rates at a lower rate, and then they lend out at a higher rate. And that spread is how they make their money. Now, having said that, they also trade. They do a lot of trading, and they generate, some banks, that's where 90% of the profits come from. But the structure of our finance system has to do with longer rates being higher than lower rates So if you follow bonds, then you start, because that they call that the smart money, right? The smart money are these bond guys. There's no emotion. It's just numbers. Like the equities, stocks, some people love Apple stock and they're going to buy it no matter what. And so that emotion really clouds what the markets are telling. That's why they tend to be a little more difficult. So does that, I know it's a long-winded answer to your question, but does that give you that?
Yeah, I totally agree. Above all human intelligence, all those technical analysis, I will finally bow down to the Lord, because everything really is in his control. But from the technical or practical perspective, really no longer that matters. If this will not be relatively less risky choice, you really cannot find other thing else.
Right.
Like for the CD, it's no higher than 3% in the last 80 years.
Right.
So you are losing money with a 20% inflation sitting in the bank anyway. So compare with that, I might think of move a portion towards the bond market rather than to the stock, which gonna have more volatility or risk. But I totally agree. As I'm watching some information that the Chinese local banks, they cannot like provide the clients cannot withdraw money for their deposits. So there are a lot of bankruptcy there, and the local government bank got bankrupt. And that will start another wave, just like COVID a couple of years ago. It's not something unreasonable. We could understand when the government shuts down everybody, slows down. It's just completely just kills all the economic development. How can people survive? So if that's such bankruptcy from banks, local banks, not happening, we will ask a question, why is that? So it is very reasonable to have what is ongoing, but that will definitely affect here than decades ago. Like before the world is flat, we might really nothing to do with other countries' issue. But now as we are so much connect and depend on one another, like financially, so there will be huge impact. I do see the things coming on the way. It's not a very good. It may be worse than we can think of.
Yeah.
So do you have any idea about the 1917 or the Great Depression? What's the world looks like back probably 100 years ago?
Yeah, it's about that. You know, and we can list, there's a long list of problems happening in the world. And obviously it's one of those things that, and one thing we haven't talked about, right, is like, can you make money on the downside even if bonds are down? And the answer is yes. It's just there is an expression that says that bulls they climb the stairs and the bears jump out the window. And what does
Yeah.
that mean? Or
Mm.
bulls means that the market is going up, and when the market is going up, it goes up slowly, because wealth creation, which is why the stock market goes up, wealth creation, it's a slower process, right? Somebody learns to deliver something faster, somebody makes a part cheaper, somebody makes something stronger, so all these things, they don't happen all of a sudden, right? There's an incremental pace, which is what creates wealth. The wealth creation idea, right, is that things get made faster, cheaper, better, right, stronger.
Mhm.
So that's why it goes up slowly. But then the downside, when things drop, they drop fast. They
It is.
drop, within a week, and it's hard to catch that. But if you are able to, if you find people that are skilled enough to capture that downside, boy, it can make a difference, right? It's like,
Mhm.
there's inverse funds, and we're not talking about anything of the strategies that are there. But look, from my perspective, if things drop, it's going to be one of the greatest opportunities that we'll have in our lifetime. The last one was 2008, 2009. We had
Right.
the COVID drop. The COVID drop was really, how would I say, tactfully, because I know a lot of people got hurt, is that very great opportunity from me,
Yeah.
and some of the people that I know, just because you have to understand that, and Warren Buffett says it nicely, that when there's blood in the streets, that's when you have to go buy. When people are fearful, that's when you have to go in. And so the question is, did you go in too early, right?
Mhm.
That's always the difficulty in doing these things. So if we do anticipate things dropping more, maybe developing some cues. And we talked a little bit about the bond markets. The bond markets are really good predictor of what can happen. There's various others economic indicators that really do a good job. Following the residential ETFs are good. VNQ is a Vanguard real estate ETF that you can track, and you can see how it's doing, and you pair that up with the bonds, and you start getting a nice picture. Obviously, most people have jobs and they're really good at their jobs, and you get to the point that you're like, I love soccer. I love playing soccer, but I'm also older, and whenever I start playing something new, I might get hurt. So that, but using that same metaphor, you don't want to start being an expert in something. You should know something about it, but maybe your ability should be about finding people that are already experts and then follow them, right? Because
That's
now
another tricky part. How do I know
yeah,
they really don't have a conflict interest? A
yeah.
book I read recently tells me he's an attorney. I think you probably know him. So he wrote a book called How to Steal a Lot of Money Legally. He's an attorney to find those flaws, scam in those
Mhm,
big funds management, how they die. So he
mhm.
says, based on his experience of 35 years in this field, pretty much 0.5% of those investment portfolios and those funding managers that you're involved
Yeah,
in are
yeah,
flawed one way or the other. So for us beginners,
yeah.
we really don't have that intellectual capacity or judgment to know what to do,
Right.
other than really start one by one, step by step to learn ourselves and just trust in
Yeah.
the Lord.
Amen.
Let him guide us our pathway, because ultimately the money all belongs to him, and he just give us demand to stewardship the money. So
Amen.
lose
Amen.
it, it's by his grace we lose, we gain, it's all his glory. So we are not really can control anything, but just trust him and learning every day.
Amen. Well, Louise, those are great comments. Let me finish up the
Sure.
presentation, and we could talk a little bit off the recording. So just to close here, the idea, I'm going to mute you for a second, Louise. Just to close out, and we talked a little bit about the paradigm shift, is like, I do want to concentrate on using one of those 4 strategies. But the question is there a paradigm shift, and which one of these strategies maybe offers the best opportunity for you to change with the potential shift? And I would say, I would deem it that perhaps the momentum strategy allows you the most flexibility. And there's a lot of questions behind that, but I do want to close with optimism, because I think that it's easy to fall prey to just being negative. And just to echo some of the comments that we've been doing, is that it's not our money, right? It's God's money. And he asks us to not be afraid. And I focus on that a lot, because, it's a struggle that I see a lot of people write me, they email me. My clients also ask a lot of questions, and they sound fearful. And in the end, it's like, God provides, right? So even if you lose it all, he will provide if you trust in him. And so be anxious for nothing, says in Philippians. Yeah, and make your request known to God. So let's do that. Let's focus on that, and let's just stay tuned to really having a plan. And when the plan breaks, you just keep going, right? And what I mean by that is change that plan when you need to. So thank you for the participants. Thank you for those that were here. Really appreciate this time. I should be able to, I'm going to attempt to be live on Sunday coming up. Just have like a 20-hour drive to make it there. So, well, bless you guys. And I hope you have an amazing week, and see if you can reach somebody by encouraging them and give them that peace that a lot of people seek, that the Lord, our Lord and Savior, gave us. All right. I'm going to stop recording now.